I am going to go ahead and introduce our speakers. So Benjamin Lau and Jose Rendon joining us again. Benjamin is a CFA. He is our Chief Investment Officer here at Apriem. He's been published in a number of different national business publications, such as the Wall Street Journal, Bloomberg, CNBC, sharing his economic and investment views. At his side, Jose Rendon, who is our Senior Portfolio Administrator and a member of our Apriem Advisor Committee. Jose currently sits on the Finance Department Advisory Board for his alma mater, Cal State Long Beach. Ben, Jose, I'm going to go ahead and pass it over to you guys to take away and get us started.
Thank you, Josh. I really appreciate the nice intro. Good afternoon, everyone. Wow, what an exciting time to talk about the state of the economy, especially after an exciting day today where we had the Fed meeting that's been highly anticipated, and we finally got the interest rate increase that's been talked about for months now. And of course, against the backdrop of the situation in Ukraine, where you had the Ukrainian president speak to Congress this morning. So it's been an exciting, crazy few months. I want to give you a quick overview of what we're going to be talking about today, right? And do a little bit of intro and talk about the business cycle, especially the American business cycle, where we are in that cycle and what we're looking for. And the reason why we look for the business cycle and look at these indicators is because these indicators give us an idea of where we are in this business cycle. Are we growing, or recession, and where are we at? And the indicators we're going to use to go over that, and we're going to use 3 different types of indicators to give us a view on the business cycle. And then after we go over some indicators, we're going to talk about what does it mean from a historical standpoint, right? What does it mean when we look back at these indicators in the past? And most importantly, what does it mean for your portfolio with portfolio implications? So the good old business cycle, right? I feel like every time I talk to you all, we always start off with the business cycle because it's so important, right? Where are we at? And we generally define there's typically 4 times in the business cycle, right? Are we in expansion? Are we growing? Is the economy kind of peaking and getting to a top? Or is the economy contracting, right? Or are we going through recession, right? And where are we and how far we are? And each phase of the business cycle really has a different kind of characteristics. With expansion, this is usually comes after recession, where economic activity is going slow and starting to get better, right? Employment, again, is starting to rise during this expansion phase, where we're not maybe at full employment, but we're still hiring a lot of people coming out of the workforce. Really, what I envision as it's the first part of 2020, right? Not really March when we're in contraction, clearly. April and May were clearly the economy was getting back and people were getting back to work. All those 20 million people that are laid off started getting back to work in May and in June and stuff. So that's really when that started happening. Of course, when employment starts happening, what happens when people start going back to work? Their spending starts picking up, right? And when spending starts picking up, inflation starts getting high. Inflation usually low, it starts getting higher. But this is really why we look at indicators. What part of the economic cycle are we in, and how do we invest here? There's so many different types of economic indicators, right? There's so many different ones that we can look at. The most popular ones is GDP, gross domestic product. How much output is America producing? Wages and inflation, so really popular ones, right? Especially nowadays when we talk about gas prices and food costs and going through the roof. Right? Housing is a great indicator, right? As you know, if you bought a house, once you buy a house, that just doesn't stop your spending, right? Once you go to a house, you spend more on places like Home Depot and Bed Bath & Beyond and carpet stores, and so that goes along with a lot of housing. Government spending, the Fed balance sheet is really important. Interest rates, of course, more the big one today. And then really the state of the labor force, state of the employment situation here in America. So those are the several different types of indicators that we have. But we generally classify these indicators as into 3 categories, right? We look at the lagging indicators, things that were in the past, gives a good insight in the past and where we were. Coincident indicators gives a good indication where we are now. And then at least I think from our standpoint, but more importantly, the leading key indicators that can tell us where the economy is going in the future, with obviously some variability, but leading indicators are very important. So Jose is going to be breaking down some of the lagging indicators for us today.
Thanks, Ben. So it's been mentioned, the economic indicators are grouped into 3 broad ranges. And one thing that we'd like to point out is that they aren't exact measures. They're not right at the turning point, but they can sort of gauge where we're heading. With like GDP, that is a lagging indicator, and usually we know that the economy is growing. We do know that the economy is in a recession. So that's an example of a lagging indicator, and that takes some time after a turning point versus a leading indicator like the S&P 500, which if you see it grow, 10, 15% in a year, that's a good indication that things are going fairly well. Unless there's a correction, it can also gauge, it's a good gauge of sentiment. So this is the reason why they're called leading, because it gives us a good insight into where we're heading. So to cover a few of the lagging indicators, which is what we tend to see in headlines most often, inflation more recently, gauged by the CPI, and the Fed's favorite inflation measure, PCE, personal consumption expenditure, but also the dual mandate of the Fed. It's to control inflation while also bringing the labor force at a great level. And they do that by controlling interest rates. And in effect, this affects the balance sheet. Specifically, we heard a lot about quantitative easing. So let's jump right into the first indicator, and that's the Federal Reserve balance sheet. I do want to note that the gray bars there on the chart are periods or recessionary periods. And it's quite clear that there were some sharp jumps in the Federal Reserve's balance sheet. And again, as I mentioned, quantitative easing was a word that has been used really recently. And the reason is that anytime that the Federal Reserve is increasing their balance sheet, they're putting money out into the economy. And what they're trying to do is effect some stimulation, get the economy to get going, get it to start to heat up. And a big concern there with putting money into the economy really is inflation. So the following graph here, we will look at the money supply compared to CPI. This is a chart showing that as of 2002, comparing what inflation has done in gray versus the money in circulation in the economy, the blue line, even though the money supply has continued to grow and has CPI or inflation really hasn't tracked the money supply. So just because there is a larger amount of money being pushed out into the economy doesn't necessarily mean that inflation is going to follow the same pace.
Yeah, this is a really common chart where we have a lot of questions about money supply and, well, money supply has increased, so inflation has to come, right? In traditional economics, I think there's another part of that equation, right? Money supply and inflation don't equal. There's a component here called velocity. When money starts moving around a system, that also helps increase the inflation. You can see here that just because we increase the money supply, the velocity has continued to be low, and that really hasn't led to much inflation. So, when everyone talks about money supply increasing, inflation has to increase, that's usually a fallacy.
Yeah, thanks, Ben. So continuing on inflation, there's two big measures here. There is headline inflation and then core inflation. And we'll see that the blue line, the headline inflation, jumps around quite a bit over the last 20 years. And that's because headline inflation includes volatile prices such as energy and food. More recently, we've seen how sharp those moves can be. And in the dark gray line, core CPI, removes the effects of the sharp movements in energy and food, and we can get a better gauge of what the trend is like. So continuing on, what the Fed does with inflation is try to control it, and they do that by changing interest rates. Now, this chart here shows the last 50 years of the federal funds rate, but as Ben pointed out, today was quite an important day.
What happened today?
Yeah, the Fed did meet and informed the economy that they're going to be raising, or they did raise interest rates by a 1/4 percent point. They also signaled that because of inflation and because they want to tame it, they will likely signal that they are going to raise interest rates by another 6 times. Now, a hike doesn't necessarily mean that we're going to get some crazy high borrowing rates. It's a 1/4 percent point. So in comparison to the last 50 years, really that's just going to look like a blip there. So moving on to the next chart here, one measure of what the economy is doing is the output gap. And what this is an estimate of how much the economy can essentially grow. Now, the blue line is the estimate, potential GDP, but the actual reported value is there in gray. And we can see that there were some times where GDP did trend above potential GDP. Now, this can't continue in the long term. However, at the current moment, GDP is still below potential GDP, just giving us an indication that we're not necessarily in an overheated economy.
Yeah, I mean, what this chart really shows me here is that, exactly, so we're not really in an overheated economy, even though inflation is happening. But I really feel like the inflation issue really stems from a lot from the supply and demand imbalances that we have still coming from COVID. And there's still plenty of output gap left for the economy to still grow without overheating. So I think this is a great chart, Jose.
So the following chart here really is what the economy is doing as far as activity. GDP is a measure of economic growth. Now, looking again here at the gray bars is, again, recessionary periods. And really, anytime that we hit a recessionary period, it's pretty clear that there was a decline in GDP. More recently, with 2020, we see that sharp decline, even getting to a negative rate. But an important thing to point out here is that just because GDP might be falling from 4.32%, those values are still positive. It's still positive growth. As long as there isn't substantial periods of negative growth, then the economy should fare well in the long term. And obviously, one other major lagging indicator is the unemployment rate, again, highlighted by the recessionary periods. Anytime that there was a recession, workers struggled, and as a result, there was job losses. And we do see that the unemployment rate happened to spike shortly thereafter. Looking at 2020, over the last 20 years, we haven't seen such a high unemployment rate. And that's because the economy was completely shut down. Manufacturing plants, business owners, they had to close down their business. And as a result, we saw a really large unemployment rate.
And this is the reason a little bit why we're so optimistic, right? And it's because you can see this is one of the fastest unemployment corrections we've seen and fast recoveries, right? You can see after the great financial crisis, look how many years it took, almost 10 years to regain all those jobs that we lost during the GFC. Here, it took us about 24 months. So it's pretty quick recovery. There's some other types of indicators we look at, and they're called coincident indicators. Indicators that are more real time, right? They kind of give us a current state of the economy. There's a few that we really like to look at to really kind of give us a gauge in wages, how much you're making, how much you're saving, how much more you're making, hopefully, and then the labor force, how many people are actually working. And both these are generally monthly numbers. The first one is disposable personal income. How much income do Americans actually have to spend, right? And this has been a popular chart. It does dip down, obviously, when recessions are. We had the great financial crisis, but it's been relatively steady, growing in the mid single digits here for the past few decades, and that shows you the strength of the American economy and American consumer here. Also, note that personal income has steadily grown while fuel costs have actually decreased as a percentage of disposable income. Wage growth. Wow, this is this is one of the more popular ones, right? And it's hard to talk about inflation without talking about wage growth. And here we've seen, after decades of really stagnant wage growth, right? Wage growth in the look at percentages from the late 90s till now, it's been really no more than 5%, right? You're only at 3 or 4%, up until recently where it's spiked up, and that's really what you're seeing here. As an employer, we can see these effects on hiring, right? And not only is it hard to find people, wages are definitely going up pretty dramatically. This is generally good, right, for Americans, because it does help meet the effects of inflation. But we also know one thing we track this so closely is not just that. This helps us give us a future gauge in inflation, because wage growth is what we call sticky inflation, right? Inflation doesn't totally go away like Jose's talking about with gas prices and food prices, right, where they go up and down. Wage inflation tends to stick around a little bit longer because it's hard to give someone a raise and take it away, a year later. So this is something that we look at, and it is continue to grow to be quite high.
So before jumping, right into leading economic indicators, we have these lagging indicators, we have these coincident indicators, which is great. And I say it's a little tongue in cheek, but it's almost like thank you, Captain Obvious, right? Okay, that's where we're at. So I mean, are you and your team really paying that much attention to lagging indicators?
Not really, Josh. That's a great question, right? Like with any, with any roadmap, we like to know where we're at first, and then see where we're going to go. And we can't tell where to go if we don't know where we're at. So that's just a good starting point for us, right? And they are kind of obvious points. Oh, we know that unemployment's at 3%. We know that GDP has been high for the last few months. But we do pay a tremendous more attention to these leading economic indicators. These are the predictors of future demand, future growth. Where are we going, right? And we generally classify them into about 5 different categories here. I'll start from right. The S&P 500 is a popular one, right? Then we got some GDP, future-looking GDP numbers, same categories: labor force, interest rates, housing. Those really give us a good indicator of those kind of metrics. So the first one is something like, the S&P 500, right? You really think of it as a typical leading indicator, but it does. It has that wealth effect, right? When the market does well, especially after post-COVID, people feel wealthy. People spend more. They might buy a new car. They might buy a new house. They might retire sooner because of that wealth effect. So this is a great leading indicator. You can see here, even after the correction we've seen so far this year, the market is still at a relatively high, only about 10% off the lows. One of my favorite ones is housing, right? Although we don't spend a tremendous amount of time in residential real estate, this is essentially extremely important because our clients have a lot of their assets in residential real estate. One of the 2 things we look at for housing, for the housing economy, is building permits and housing starts. Building permits, and anyone that's done construction recently on their home or office here knows that you need to pull permits, or you should pull permits, I should say, before construction. And that's a great indicator of future construction, right? Why would no one logically will pull a building permit with the city of Irvine or the city of Laguna Beach unless they were going to do some construction, right? No one wants to just wait in line or pay those fees at City Hall, right? And so that usually can signal future growth. Housing starts. If you're going to build a house and start building a house, hopefully that house will get sold, and hopefully that house, when they get sold, that'll also mean more demand, right? This is the start of demand. So when you buy a house, there's a lot of things you have to do. You have to buy. All of a sudden, your old dining room table in your old place doesn't fit in the new place. You have to buy a new dining table. You start going to Home Depot every weekend and spending hundreds of dollars at Home Depot every weekend. So that just kind of leads to future demand. That's why we think this is tremendously important. This still continues to be quite optimistic, and one of the reasons why we're optimistic on the housing market. Generally speaking, we still do not build enough homes for starter families here in America. We just don't. Another lead indicator that I like to look at is corporate and high yield credit spreads, right? I like to look at the state of the finance markets here in America, right? Because lending and borrowing is such a huge part of businesses, right? Most businesses do some sort of lending to fund inventories or supply chains or production. And so allowing them to have cheap cost of capital is tremendously important for the economy. And so what we did here is we graphed out corporate spreads, the high quality companies in gray, and then high yield companies or lower quality companies in blue. And you see how much yield extra are they having to pay over, say, the US Treasury to get funded. High quality corporate credit generally pays about 1 or 2, 300 basis points or 3% over treasuries to get funded, right? That's how much their debt costs. Junk borrowers or high yield borrowers pay a little more. They pay anywhere between, say, 500 or 5% more than treasuries to get funded normally. But you can see these spikes here when the market just seizes up, and it's so hard for even high quality companies to get funded. Apples and the Pepsi of the world. In fact, we saw that in 2007 and 2008, 2009, where Pepsi couldn't even get funded to make sodas. We saw that here a little bit in 16 and 17. Do you remember what happened then, Jose, in 16 and 17?
Yeah, there was big geopolitical events, and there was also increases in prices of oil. So that led to high yield companies saying, hey, I can't hold, at least for investors, not saying I can't hold the risk. I want to go into the investment grade.
Exactly. You saw that those disruptions affected the high yield market more than it did the investment grade market, because generally oil companies, smaller banks are junkier than high quality companies. And then obviously you saw it right now, right? In the past COVID break, we saw a huge bump up in yields or in spreads, and that did quickly come down. Right now, spreads are pretty tight, what we call tight. I mean, that I'm not getting paid a lot to take on extra risk. These high yield, these blue companies aren't paying me enough to take on the initial credit risk of loaning to them, because I think they're not as great companies. So when we look at this, when we notice the spread is quite tight, that's when we tend to say, am I getting paid for that risk? Is it really worth it for me to take that lower quality company? And for us, we don't. right now, almost across the board, we have no high yield bond exposure because we do not think we're getting paid enough for this extra risk that we're taking.
Is there much of a correlation between really what the Fed is doing with interest rates and when we're looking at these corporate interest rates?
Yeah, I don't think so. I think the Fed it's more the opposite way around, where the Fed will have to respond to these reactions here, right? And this is usually when the Fed will lower interest rates or do some sort of issue to solve that. And we saw that a few years ago when you saw these spikes here. That's when the Fed started doing these what we call reverse repo agreements in the last couple of years, and that really just stemmed those issues too. So the Fed kind of acts behind the scenes and more reactive to this to make sure everything's calm.
Thank you.
Another leading economic indicator is unemployment. We talk about unemployment so much, but this one is the weekly unemployment claims. We didn't see this a huge effect in the great financial crisis, but we saw a huge effect during the COVID crisis, right? And you see when these businesses were shutting down, restaurants and businesses were shutting down seemingly overnight. Before a worker could actually get unemployment, they had to file an unemployment claim. And so you think that would lead to future unemployment, right? And so yes, you saw a huge spike the spike was so high we can't even graph it on this chart here. And so but then the spike it came down really quickly. And when we saw unemployment claims coming down really quickly in 2021, late 2020, 2021, that's when it gave us a lot more optimism to be bullish, right? The employment situation in America was quickly correcting itself. Right, and we were shocked. I mean, I don't think 20 million people unemployed, and all of a sudden they got back to work. It was pretty impressive. Another leading economic indicator is something called durable goods, right? And what do we think of durable goods? Like big things, right? Like jet turbines, refrigerators, washing machines. So something that was hard to get in the last few months. But this really signals demand for manufacturing, production type stuff, right? Rolls-Royce is going to make an engine because Boeing is going to make a plane to put that engine on, right? And so these goods have been shooting dramatically higher. And this really gives you the strength of what's happening in the economy behind the scenes. Even though we see the market being quite volatile this year, given interest rates and everything Jose's been talking about, producers, manufacturers are still quite bullish. They're still demanding a lot of goods to get this economy back up and running. And so that's quite a bullish sign here. Historical view. So we want to talk about what this means from a historical standpoint and what does it mean for you guys. So nicely, the US government, the Conference Board here in America, wraps up a lot of these leading economic indicators we were just talking about into one simple index, just to make it simple, right? Just to make it easy. And so every time this basket of indicators that we just talked about goes down, goes negative, it generally does mean that a recession does happen. Not right away, 6-9 months later, but a recession is on the horizon, as indicated by these gray bars here. You can see that happened in the early 90s, before it happened in the 2000s, before the tech wreck, happened with the great financial crisis here in 2006, 2007, and it happened even briefly with COVID. And so that's a great indicator of what were the base of the economy is and how is it doing. And so far, the base of the economy is doing quite well. It's fallen off a little bit here, but it's still quite strong in the positive category. And that makes us think that we're still quite optimistic for the economy over the next few years. Another leading economic indicator is kind of an odd one. I do think this is kind of weird, is crude prices. Crude prices are an interesting leading economic indicator because it is so important to the global economy. Any price spikes in crude generally increases the cost of energy, transportation for not just you and me, but for the whole economy, right? For manufacturing, for production, for homes. And anytime we have these huge energy disruptions, it does tend to slow down the economy quite a bit. We saw that in 2006 and 2007, right before the great financial crisis. You saw that a little bit before the tech wreck too, by the way. This is quite noticeable here. We have to point that out. This is one of the things that does worry us about the economy. A prolonged high crude oil price could slow down the economy quite a bit, not just here in America, but more so here in Europe and India and some of these emerging market countries that don't produce as much oil. And so the good thing is, though, is that this has been coming down. You know, it peaked up about 130, 135 over the past few weeks and has come down significantly to back under $100. So we're watching that very closely for us. One of the biggest indicators that I use personally is something that we've been talking about here at Apriem for a few years now, right? And this is what we call the yield curve and the slope of the yield curve, right? So what we grabbed out here is the treasury curve It's the 10-year treasury minus the 2-year treasury, two of the most popular treasury trades out there. And so the 10-year is a longer-term treasury bond, right? One of the most active treasury bonds that trade out there. And you should get paid higher to loan the government money for 10 years, right? And if I loan the government for 2 years, I'm not going to get as high as loaning the government money for 10 years. And so there should be a big spread. You get paid more, but that doesn't always happen. And sometimes when investors are really nervous, they buy a lot of 10-year treasuries to lock in their interest rates and pushing that yield down. And at some points, this has happened for decades, when the 10-year treasury is actually paying you less than the 2-year treasury. That means everyone's rushing the 10-year and push the yield down. You see these spreads coming down here, these negative areas right here, where the 10-year treasury is yielding less than the 2-year treasury, which is rare. It's another great indicator of an upcoming recession. And the worrisome here is that the only recession I didn't predict was the COVID one, so the yield curve barely fell down there. But you can see here the yield curve, the spread between the 10-year treasury yield and the 2-year treasury yield is narrowing. It has been narrowing quite a bit. This is another worrisome sign that we've been looking at, right? At first it was recovering, and then with Ukraine, it took another leg lower. And so this is something in the market is telling us that there's something is not right. And so that's what we're looking at. Traditionally, what we do have to say that we want this yield curve to what we call invert, like it is here, for more than a month. It has to more than invert for more than a month, not just a day or a couple of days, before it's actually a good signal. Look, the longer it inverts, the better the signal it is. But right now, it is something that we're looking for right now. So what? Always ask the question, so what, right? And so what happens if the yield curve does invert? What does that mean? And our team, Jose and our investment committee, and Andrew and Katie on our team, actually look back and go, hey, well, let's take a look at this. And so what we did is we pulled this Wall Street Journal piece talking about how does the market, even though the recession on the horizon, how does the stock market do when the yield curve inverts? And what we found out is that the market actually does okay when the yield curve inverts. After 3 months after the yield curve inverts, the market is up slightly. 6 months after the yield curve inverts, the market is up slightly. And same 1 year, 2 years, 3 years later. Also, the market actually, despite the conventional wisdom that a recession is bad, the market actually does do okay over the longer period of time. Kind of have a little bit of a blip, and the market kind of moves on and gains back its momentum. So that was surprising to us. So even if we see this yield curve, I wouldn't be too afraid just because the yield curve invert doesn't mean that there's a huge desire to go to cash.
I think this is one of those prime opportunities to note that while they're correlated, the market and the economy are not the same thing.
Yes.
Right. So, and I think that 2020 was the biggest and most obvious time for all of us. We can all kind of remember 2020 came. I mean, technically, we had the technical definition of a recession, right? 2 quarters of negative GDP, but the stock market kept going up, and we saw it continue to grow up. I think last time I checked, from the lows of March of 2020 to now, as it was over 80%. And it just shows tremendous growth, even though the economy itself did not do as well.
Exactly. I will have to say, Josh and Jose, we did look at history. This is an average of the last few decades. There was one outlier, and the outlier was clearly the tech wreck in 2000, where after the yield curve inverted, the market was down a year or 2 years later. So let's look at that a little bit. And so what we did is we looked at some data points, because it's important that we look at these economic indicators and not just use them as a rule, right? They're not a rule. We have to look at them and what the current situation that we're in. So let's look at that right now with it. So we took some data points, and these are all from JP Morgan. Looked at the tech wreck it's almost 22 years ago. In March of 2000 versus yesterday. The S&P 500 was at 1,500 back in 2000. Now the S&P is at 4,300. Well, that's a big jump. We got to fall, right? But let's look at some other statistics. Let's look underneath, because the profits and earnings have still grown. Dividends have still grown. The dividend yield on the S&P 500 is actually higher now than it was back in 2000. 1.4% versus 1.5%. So we're actually getting paid more in stocks than now. The P ratio, a measure of valuations for how expensive stocks are, was 25.2 back in 2000. Now it's under 19. This is 2000 was the time where companies just were not profitable. But big companies now in America in 2022 are much more profitable than they were. Even big technology companies like Apple and Amazon are much more profitable now. We turn the profitability ratio to a percentage, because I think that's a better way to gauge it, especially relative to interest rates. The earnings yield on the S&P 500 back in 2000 was under 4%, right? How much profit you were earning off the index was just under 4% in 2000. Now it's over 5.25%, 5.2%. So we're earning a lot more in profits. You have to take that into consideration where the yield curve is, right? If you're going to say, if you had $1 to invest, well, what I can put $1,000 into treasuries and earn 6.2%, or $1,000 into stocks, earn 3.9% just in profits. What's the better bet, right? And it's clearly 2000, bonds were much more valuable than stocks at that point. But look at it now. The earnings yield is so much higher, more than twice as high as bonds. So you have to take valuations and profits in light of interest rates. And so we can see here that the earnings yield is still much higher. This last two things are called the Fed model. Buffett uses it too, but it just says how expensive or cheap stocks are relative to bonds. And anytime, and this is what we graphed out here over the last few decades, you can see anytime we're above the 0%, that means that stocks are overvalued versus bonds. And anytime we're under in the blue, under the black line, that means that stocks are cheaper than bonds. Cheaper and that's usually because of how low interest rates are. You can see bonds or stocks continue to be cheaper than bonds even now, even with this. Given how low interest rates are, given even the risk, we think that stocks still offer a much compelling value if you can stand the risk versus bonds, because they have much of better growth opportunity, growth potential, and inflation beating potential. So what does this mean for our portfolios?
One of the questions that gets asked a lot is, when do I invest, or what do I need to pull out my money? But I think this is a really great study here. The chart displays the S&P 500 returns over the last 20 years, and it shows us that on average, the S&P 500 earned about 9.5%. But as you remove the top performing days, you substantially lose a great amount of the returns that you would make on that year. And if you exclude the top 10 performing days, just 10 days out of those last 20 years, you almost lose half the return had you just stayed invested the entire time. And I think that's a really great point to drive to investors, is that, don't time the market. You don't know when a good or bad day is going to happen. Just stay invested. Josh does have some great comments here on the stats for the returns.
Yeah, so I actually told Jose when I saw that, I love this slide. This is one of my favorite slides to talk about when it comes to very volatile times like we're experiencing right now, right? The market's very volatile. A lot of the conversations that I and a lot of the other wealth managers here are having on a daily basis right now are, hey, is it time to get out of the market? Are we going into a recession? There's a lot of fear happening right now. So if we look at this and we really think about it, we're looking at the S&P 500 from 2002 through 2021. In each year, there's about 253 possible trading days. So over this 19-year period of time that we're looking at here, that's over 4,800 possible trading days. We look at this, right? If we had just stayed invested in the S&P all the way through, well, we would have averaged 9.5%. But if we miss the 10 best days, all right, so we're talking 10 days out of over 4,800 possible days. We missed just 10. We're now cut basically in half. We missed 20. We're down under 1%, right? And you can see how the scale goes from here. Oftentimes, those best days tend to be very, very close to when we had some of the worst days, right? So if we were to go back to 2020, the market bottomed March 23rd of 2020. Well, the best week that we had seen in the market was essentially the week following when we bottomed the market at that point in time. That was the best week we had seen since 1974. The point is that oftentimes these very large returns, these best possible trading days that we're talking about, tend to follow periods of time when the market has fallen substantially. In fact, I'll take everybody's mind back to about 3 weeks ago. It was a Thursday morning. We woke up, the stock market was down about 700 points plus when I woke up and looked at it. And that was because Russia had invaded Ukraine. And it's terrible news. By the end of the day, surprisingly, that was a Thursday, the market had ended up. And that following Friday was the best day in the market we had actually seen so far this year. Now, I don't know if at the end of this year that's going to be the best day this year, but I think it goes on to continue to tell this same story that we're looking at here, that time spent in the market is much more valuable than trying to time the market. it's just far too easy to miss some of these really, really good opportunities.
And the penalties are devastating too if you happen to miss those days.
Yeah, absolutely.
And that's a really great point, because that drives the point home for any investors that do want to sell out of all their positions, just move to cash. The chart here just shows how really insignificant over a long period of time a bear market lasted. In over the last 50 years shown here, we can see that the span of a bull market or an increasing market vastly outsize the duration of a bear market. So if your time horizon really is 5-10 years, it really is worth it to not react on any sort of news. Don't let your feelings affect your portfolio. Remain invested, stay with that allocation so you don't miss out on those top performing days. And if you do happen to sell and it happens to be on one of the worst days of the market, you don't realize those losses. And again, in the long term, you do happen to perform, as Ben mentioned.
It is tough though. I mean, I love this chart because it illustrates a lot of points. But it is in the heat of the moment. This is why they call us the stock market a roller coaster ride, right? It's a slow ride up and a quick ride down. Even though these periods here that are only down 31 months or 17 months, they're down 30, 40, 50%. That's why it is so emotional, so tough to stay invested, and I sympathize with a lot of our clients that have been through all this, especially in the last 25 years. We've had quite a few of them. So how do we make sure that we stay invested? How do we make sure that our clients stay to goal, right? As you said, Jose already mentioned, we're not traders. We're investors. We're not thematic traders. We didn't make a huge bet on COVID or for COVID or against COVID. We didn't make a huge oil play or Ukraine play. Those things can really rip your face off, like this chart shows, right? Because you have to get in really quickly and out really quickly. This is because we're not traders. We're investors. We take a long-term approach to investing. And so when we look for a company, we look for several things. We want a high-quality company with a great moat, right? That's a fancy term for it. We want a company that has a competitive advantage that their competition is having trouble keeping up with, right? They're doing something different. They have some maybe legal moat, right? With the legislative, they can only be 2 telecom companies, or they have some sort of proprietary technology or some cost advantage. They're doing something different that differentiates themselves from competitors, right? We want to have these companies as a long-term holding so they can withstand a market cycle, right? With them be quality, strong balance sheets, right? They have some sort of growth in them. We also want companies with durable cash flows, right? The revenues sometimes are really resilient. They're not as volatile as some other companies, but also importantly, we want them to have very strong cash flows. Are they making money? Does that drop to the bottom line? What kind of profit margins do they have? Are those profit margins safe? Are they expanding, right? And when they have these kind of characteristics, we think that they're able to withstand market cycles, because we don't know how long this market cycle is going to last. But if a company has a great balance sheet going into a recession, strong cash flows, decent revenues, and they might come down, truth be told, they can make it out of the recession, right? And so that's why it's really important, is to make sure that we hold names for the long term. And then the hardest part, it really is to make sure we buy these companies, because we have a shopping list. Jose is the one that does the shopping list of our holdings every Monday. He buys them every Monday, but we only buy them when we think when we think the valuations are favorable. We try to not overpay for companies, and so that's the huge thing too. Is if you don't overpay for a company and you buy it at a great price, it gives you a lot of durability to stand through the ups and downs of the market. So that's really, how Apriem looks at this. We try to take a look at all the economic indicators. So the lagging indicators, see where we've been, look at the coincident indicators to kind of match up with that, and then really pay a lot of attention to the forward-looking indicators to see where the economy is going. Are we going in the right direction? But with that, we also know that we want to buy great companies that have a great resiliency to withstand the storms of the market, the roller coasters of the market, and allow us to hold them through, because we can time it. Right, and you can see the last 3 months have been particularly painful. That it's hard to time the market and be in and out at the right times. So that's we hope you enjoyed that and kind of give you some insights of what looking at, especially as we see the next probably rocky rest of the year in terms of what's happening in Ukraine and interest rates and oil.
Okay, so the first one that we have here says, Fed's financial policies have favored the stock market, but they have relaxed controls, allowing big oil, big meat, big etc. to keep prices high. What are the long-term effects to the market from the lack of competitive prices from our major companies?
Yeah, so this is a complicated one, right? Because there's two different parts to this equation here. And the government is not one unilateral organization. And in fact, the government is one organization, and the Fed is actually not part of the government, right? The Federal Reserve Bank, the Federal Reserve is actually independently owned by the banks in America. So they're actually completely separate organizations. What the Fed has done by keeping interest rates low to prop up the economy and control inflation and really unemployment, that was the main goal. They had, I would argue that they did not intend to have those disruptions that they're talking about, the higher prices and a lot of these commodity costs. And I think that was probably just an unintended side effect. And then and I guess the other side of it is that, well, what happens if the Fed didn't raise interest or didn't cut interest rates or didn't stimulate, right? Would a depression have been a better alternative for the American economy? I would argue no. I think a depression is probably a worse thing for the American economy than high meat and gas prices. The Chairman Powell talked a little about this today. There's still a tremendous amount of supply and work imbalances in the economy where people aren't working the same jobs that they did 2 years ago, and that I think is still has this large factor in high prices for meat prices or food prices or gasoline prices, right? And remember, gasoline prices weren't this high not so long ago. Just a few years ago, they were negative, and so much so that most American frackers laid off a substantial amount of their workforce, and they really haven't hired them back. The Fed can control some parts, but the government's not really loosening up restrictions to make oil easier, right? And I do think, just given what's going on right now, yeah, I think regulations, we need to be more energy self-sufficient. Americans don't use the oil that we produce, right? The oil that we produce is too heavy, and we're better with light crude than heavy crude. And so usually the oil that we produce here, right here, goes out of the country, and then we get oil from other parts of the country, namely the Middle East, because it's easier to refine and cleaner to refine.
Does the Fed need to act faster?
That's a great question. I mean, I think the Fed here in America with Mr. Powell is in a particularly tough situation here with everything you just said. As you talked about last week, the only person that has a worse job than him right now is arguably Christine Lagarde over in Europe, right? Where the same problems here in America, just way worse, right?
Yeah.
Much slower growth, much worse unemployment, and much higher energy prices. In hindsight, I think without the Ukraine situation, I think it would have been okay. I think the Ukraine situation definitely exacerbated inflation concerns and that they're already getting worse. Unfortunately, Josh, if when we look back at what the Fed actions have been for the last 20 years or so, even back to a certain extent Greenspan with Bernanke and Yellen and now Mr. Powell, the predominant prevailing wisdom for the Fed has been to avoid Japan. And that was really the mandate, with Japan having a devastating recession. And then when things started getting better, they were quick to raise interest rates, and that really sent them into a secondary echo recession. And just like how many economists study what our reaction during the Depression in the 30s, a lot of modern economics is focused on what happened in Japan and raising interest rates too soon and stifling it, choking off an economy that's just getting back on its feet, right? If someone is trying to get back up, you don't punch them again. And so I think that was really the prevailing wisdom for many Fed governors up until now. And yeah, I think in hindsight it's always crystal clear. I think the Fed was probably a little bit too late to act. They should have acted a little sooner. But
You said the markets are likely to be rocky really through the rest of the year. Do you think the year is going to end positive or negative?
It's hard to say, right? We have 9 months left in the year. We're down about, before the closing price today, we're down about 9.5, 10%. And so even if we stayed flat from here, we'd still be negative, right?
Sure.
Even if the market even if we're down 5% for the whole year, that would mean that we just had the worst year since the great financial crisis. I do think there's a high amount of uncertainty right now going into the economy, especially with the Ukraine situation, like you just asked us, Josh, right? Especially with oil prices. So it gives people a little bit of concern going out there, and that's normal. And I think that's true with anyone that has to buy oil or go to the grocery store. So I think that there's a strong possibility that the market could be slightly down for the year, but I don't think it's gonna be down much. I think
Right.
the economy is still extremely strong. The unemployment situation is still extremely good here in America. Savings, and the Americans have a tremendous amount of cash, still earning zero in their checking, savings, money market accounts. That's finding a home. Although I think this year might be negative, there's a small chance it could be negative. I think over the next 2-3 years, I'm much more optimistic. I think the economy, the stock market, high quality American companies are still going to be the best place to be, especially in light of bonds, especially in light of inflation. I am pro America and pro growth. So.
Yep. I think it all comes down to we do not know what is going to happen moving forward. And even if we think that the market would end negative 5%, that does not mean that we think, oh, you should be selling out of your positions, you should be sitting in cash for the year, you should be waiting it out. You should be looking through this year and looking for opportunities to be an investor, long-term investor. Short term, it's going to be volatile. We don't know what's going to happen in the short term. But it was just like looking at Jose's chart that we're showing boom and busts, right? Like bull markets and bear markets. In those short term, if you're looking on a day-to-day, it can be very volatile and very scary. But we take a few steps back and we look at it in the long term, and this tells us the same story, that we should have been buying, we should have held, we should have invested, and continue to do that moving forward. So we'll see what happens. If you have any questions or need help with anything, please feel free to give us a call. And other than that, we hope you enjoy the rest of your Wednesday.
Thank you, everyone.
Bye, everyone.